If you had told me 10 years ago that I'd one day have $100,000 in passive income, I probably would have laughed, checked my empty bank account, and gone back to Googling how to make money fast. Back then, the idea of earning money while I slept sounded like a scam, or at best, something reserved for people who already had money to begin with. But here's the truth. Building passive income isn't about luck, secret formulas, or being born into wealth. It's about understanding the right sequence, making smart decisions, and most importantly, avoiding the mistakes that keep most people stuck on the hamster wheel. Let's get one thing out of the way. Passive income is not magic. It's not a lottery ticket, and it's definitely not as easy as some YouTube thumbnails make it look. If you're picturing me lounging on a beach, sipping a drink with a tiny umbrella while my bank account fills up on autopilot, let me burst that bubble right now. The reality is a lot less glamorous and a lot more achievable, but only if you're willing to do things in the right order. So why do so many people get this wrong? Why do we see folks throwing money at meme stocks, crypto coins, or the latest guaranteed side hustle, all while ignoring the financial leaks draining their progress? It's like trying to fill a bucket with holes in the bottom and wondering why it never gets full. I know, because I did it too. I spent years chasing shiny objects, hoping for a shortcut, and ignoring the boring but essential steps that actually move the needle. Here's the first big lesson. Before you even think about building passive income, you need to plug those holes. That means tackling high-interest debt, building an emergency fund, and getting your basic financial house in order. I know, it's not as exciting as buying your first rental property or launching an online business, but trust me, if you skip this step, you'll end up running in place. I learned this the hard way, watching my investments get wiped out by a single unexpected expense. Let's talk about debt for a second. If you're carrying credit card balances at 20% interest, every dollar you invest is fighting an uphill battle. It's like trying to run a marathon with a backpack full of bricks. The first thing I did was get brutally honest about my debt. I listed every balance, every interest rate, and made a plan to attack the highest rates first. I cut back on the extras, picked up a few side gigs, and threw every spare dollar at those balances. It wasn't fun, but it was necessary. And the day I paid off my last credit card, I felt lighter than I had in years. Next up, the emergency fund. I used to think this was just for worst-case scenarios, but the truth is, life happens. Cars break down, jobs get lost, medical bills show up out of nowhere. If you don't have a safety net, you'll end up raiding your investments, or worse, going back into debt. I set a goal to save 3 months' worth of expenses, then bumped it up to 6. It took time, but it gave me the confidence to start taking calculated risks, knowing I had a cushion if things went sideways. Now with the basics covered, I could finally focus on building real, sustainable passive income. And here's where most people make another mistake. They try to do everything at once. They buy a little crypto, dabble in stocks, maybe start a blog, and wonder why nothing seems to work. I learned that focus beats frenzy every time. So I picked one strategy to start with, something I understood, something I could control, and something that fit my risk tolerance. For me, that was dividend investing. I know, it's not flashy, but the idea of owning pieces of real companies that paid me just for holding their stock, that was a game changer. I started small, buying shares of companies with a long history of paying and growing dividends. I reinvested every payout, watched my portfolio grow, and let compounding do its thing. It wasn't overnight, but after a few years, those dividends started to add up. I remember the first time I got a $100 dividend check. It felt like winning the lottery, even though it was just the result of patience and consistency. But I didn't stop there. Once I had a solid foundation in dividend stocks, I started exploring other streams. I looked into real estate, but not in the way you might think. I didn't have the cash or the stomach for fixing toilets at midnight, so I started with real estate investment trusts, REITs. These let me invest in real estate without being a landlord, and they paid out regular dividends too. It was another layer of passive income, and it helped diversify my risk. As my confidence grew, I started to branch out. I launched a simple online business, a blog about personal finance, sharing the lessons I was learning along the way. At first, it made pennies, but over time, as I built an audience and learned about affiliate marketing and digital products, those pennies turned into dollars, and those dollars started to add up. The best part? The work I put in up front kept paying me, month after month, even when I took a break. Here's the pattern. Every time I added a new stream, I made sure it was built on a solid foundation. No debt, emergency fund in place, existing streams running smoothly. I didn't chase the next big thing until I'd mastered the last one. And I always reinvested a portion of my passive income to keep the snowball rolling. If you're still with me, you might be thinking, that sounds great, but where do I start? Or maybe you're wondering if it's too late, or if you need a ton of money to get going. The truth is, you can start from wherever you are. The key is to follow the right sequence, avoid the common traps, and keep focused on the long game. Let's get into the nitty-gritty, because this is where most people either get stuck or get started. I want you to have a clear, actionable plan, not just a list of ideas, but the actual tools and tactics that worked for me, and the pitfalls I wish I'd avoided. If you're taking notes, now's the time to grab a pen. First, let's revisit tracking every dollar. I started with a basic spreadsheet, but quickly realized I needed something more robust. I tried a few apps, Mint, YNAB, and Personal Capital. Each had its pros and cons, but the point was to find a system I'd actually stick with. For me, the breakthrough was setting up automatic alerts for overspending in certain categories. It was like having a coach in my pocket, nudging me back on track whenever I started to drift. If you're not tracking your spending, you're flying blind. The clarity you get from seeing exactly where your money goes is empowering, and sometimes a little shocking. When it came to automating savings, I set up recurring transfers to a high-yield savings account. I used Ally Bank, but there are plenty of good options. The key was making the transfer happen right after payday, before I could even think about spending it. I also set up a separate account for my emergency fund, so I wouldn't be tempted to dip into it for everyday expenses. Over time, I increased the amount as my income grew. Even small increases, $5 or $10 more each month, made a big difference over the years. Building my emergency fund was a grind, but I made it a game. I sold stuff I didn't need, picked up freelance gigs, and funneled every windfall, tax refunds, bonuses, birthday money, straight into savings. I kept the fund in a separate, hard-to-access account to avoid temptation. When I finally hit my 6-month goal, it felt like a superpower. Suddenly, I wasn't living in fear of the next flat tire or medical bill. That peace of mind was worth every sacrifice. Paying off high-interest debt was the next mountain. I used the avalanche method, attacking the highest interest balances first. I called my credit card companies and negotiated lower rates. Sometimes it worked, sometimes it didn't, but it was always worth asking. I also transferred balances to 0% intro APR cards when I could, buying myself time to pay them down faster. Every time I paid off a card, I celebrated, sometimes with a cheap pizza, sometimes just with a happy dance in my living room. The momentum was addictive. Now, let's talk about investing. I started with index funds because they're simple, diversified, and low cost. I opened a Roth IRA with Vanguard and set up automatic contributions. I chose a target date fund at first, then later switched to a mix of total stock market and total bond market. The beauty of index funds is that you don't have to be a stock-picking genius. You just ride the market's long-term growth. I ignored the noise, avoided day trading, and let compounding do its heavy lifting. Over time, my dividends started to trickle in.
At first, it was pennies, then dollars. Then, one day, I realized I was making more in dividends each month than I used to make in a whole week at my first job. Real estate was my next frontier, but I took a different approach than most. I didn't have the cash or the stomach for fixing toilets at midnight, so I started with real estate investment trusts, REITs. These let me invest in real estate without being a landlord, and they paid out regular dividends too. It was another layer of passive income, and it helped diversify my risk. Peer-to-peer lending was another experiment. I used platforms like Lending Club and Prosper, investing small amounts in dozens of loans to spread out the risk. The key was never putting all my eggs in one basket. If one stream dried up, the others kept flowing. Building something of your own was the scariest step for me, but also the most rewarding. I started a blog about personal finance, not because I thought it would make me rich, but because I wanted to share what I was learning.
Some loans defaulted, but overall the returns were solid, better than a savings account, but with more risk. I kept my allocations small, treating it as a supplement rather than a core strategy. Building my own online business was the biggest leap. I started a blog, but you could just as easily start a YouTube channel, podcast, or e-commerce store. The key is to pick something you're genuinely interested in, because it takes time to build an audience and start earning. I focused on creating helpful content, answering questions I wished someone had answered for me. Over time, I learned about affiliate marketing, recommending products I actually used and earning a commission when readers bought through my links. I also created a simple digital product, a budgeting template, and sold it for a few bucks. The first sale felt like magic. The 100th sale felt like validation. Reinvesting was crucial. Every dollar I earned from dividends, blog income, or side hustles went back into my investments or business. I resisted the urge to upgrade my lifestyle every time my income increased. Instead, I let the gap between my earnings and my spending widen, accelerating my progress. Protecting my progress meant getting serious about insurance and estate planning. I bought term life insurance to protect my family, set up a will, and made sure my accounts had proper beneficiaries. I also learned about tax-efficient investing, using tax-advantaged accounts, harvesting losses, and being mindful of capital gains. These aren't the most exciting topics, but they make a huge difference in how much of your passive income you actually get to keep. Along the way, I made mistakes. I invested in a couple of can't-miss startups that went nowhere. I got distracted by shiny new opportunities and spread myself too thin. I underestimated how much time and effort it takes to build something from scratch. But I learned to course correct quickly, cut my losses, and double down on what was working. If you're feeling overwhelmed by all these options, remember, you don't have to do everything at once. Start with one stream, master it, then add another. The goal isn't to get rich overnight. It's to build a portfolio of income sources that work together, so you're never dependent on just one thing. Let's talk about mindset, because if you don't get your head right, none of the tactics matter. I used to think building passive income was all about finding the right investments or the perfect side hustle, but the longer I worked at it, the more I realized that the real battle was between my ears. The way you think about money, risk, and progress will either propel you forward or keep you stuck in place. So let's dig into the mindset shifts that made the biggest difference for me, and that can make all the difference for you too. The first shift was learning to play the long game. We live in a world obsessed with instant results. Every day, we're bombarded with stories of people who made it overnight, whether it's a viral TikTok star or someone who hit it big with crypto. But here's the truth. Most of those stories leave out the years of work, the failures, and the boring, consistent effort that actually led to success. I had to train myself to stop comparing my Chapter 1 to someone else's Chapter 20. I started celebrating small wins, my first $10 in dividends, my first blog subscriber, my first month with more passive income than active income. Those milestones kept me motivated when the big goal still felt far away. The second shift was embracing failure as feedback. I used to beat myself up every time something didn't work out. Lost money on a bad investment, I'd replay the mistake in my head for weeks.
But eventually, I realized that every failure was just data. It was information I could use to make better decisions next time. I started keeping a lessons learned journal, writing down what went wrong, what I could control, and what I'd do differently. Over time, this turned setbacks into stepping stones. Instead of quitting, I got curious. Instead of feeling ashamed, I felt empowered. The third shift was focusing on process over outcome. It's easy to get obsessed with the end goal, $100,000 in passive income, financial independence, whatever your number is. But if you only focus on the finish line, you'll get discouraged every time progress slows down. I learned to fall in love with the process, tracking my spending, making my weekly investments, writing blog posts, learning new skills. When you focus on the habits and routines, the results take care of themselves. The journey becomes its own reward. The fourth shift was learning to say no. There are a million ways to make money, and the internet will try to sell you every single one. I wasted a lot of time chasing shiny objects, drop shipping, day trading, flipping domain names, before I realized that focus beats frenzy every time. I started saying no to anything that didn't fit my plan or my values. I stopped comparing myself to people who were doing things I had no interest in. Instead, I doubled down on what worked for me, even if it wasn't the trendiest thing on YouTube. The fifth shift was building a support system. Money can be a lonely topic, especially if your friends and family don't share your goals. I found online communities, joined mastermind groups, and connected with people who were on the same path. We shared wins, talked through setbacks, and held each other accountable. Having a tribe made the journey less lonely and a lot more fun. The sixth shift was practicing gratitude. It's easy to get caught up in what you don't have, especially when you're working towards a big goal. But I found that taking time to appreciate what I'd already accomplished made me more resilient. I started a simple gratitude journal, writing down 3 things I was thankful for every day. Some days it was a dividend payment, other days it was just a good cup of coffee. Gratitude kept me grounded and reminded me that progress, no matter how small, was worth celebrating. The seventh shift was redefining what enough means. When I started, I thought I needed a huge number to feel secure. But as my passive income grew, I realized that freedom wasn't about hitting some arbitrary milestone. It was about having options, the ability to take a day off, to help a friend, to say no to work I didn't enjoy. I stopped chasing more for the sake of more and started focusing on what actually made me happy. The eighth shift was embracing lifelong learning. The world of money is always changing. New technologies, new opportunities, new risks. I made it a habit to read books, listen to podcasts, and take online courses. I learned from people who were ahead of me, and I shared what I learned with others. The more I learned, the more confident I became in making decisions, and the more opportunities I saw. The ninth shift was giving myself permission to rest. Hustle culture will tell you to grind 24/7, but burnout is real. I learned to take breaks, to celebrate wins, and to enjoy the journey. Passive income is supposed to buy you freedom, not just more work. I scheduled downtime, took vacations, and made sure I was building a life I actually wanted to live. The 10th shift was remembering that money is a tool, not a goal. It's easy to get so focused on building wealth that you forget why you started in the first place. I used my passive income to create experiences, to help others, and to invest in my own growth. The money was great, but the real reward was the life it allowed me to build. If you're feeling stuck with motivation, stuck in comparison, or feeling like you're not making progress fast enough, remember, mindset is everything. The strategies matter, but your beliefs and habits are what will carry you through the tough times. Every big goal is just a series of small steps taken consistently over time. Now it's time to bring everything together and help you build your own roadmap. If you've made it this far, you're already ahead of most people because you're not just looking for a quick fix, you're ready to do the real work. So let's get practical. Whether you're starting from zero, stuck in the middle, or looking to scale what you've already built, here's how to create your own step-by-step plan for passive income that actually works. Start by getting brutally honest about where you are right now. Open up your accounts, look at your debts, your savings, your spending habits. Don't sugarcoat it. The more clearly you see your starting point, the easier it is to map out your next steps. If you're in debt, make a list of every balance and interest rate. If you don't have an emergency fund, set a small, achievable goal, maybe $500 or $1,000 to start. If you're already investing, review your portfolio and ask yourself if it's really working for you or if you're just following the crowd. Next, define your why and your goals. Write them down. Be specific. I want to build $100,000 in passive income so I can spend more time with my family, travel the world, or start my own business. The clearer your vision, the more motivated you'll be to stick with it when things get tough. Break your big goal into smaller milestones. Your first $100 in passive income, your first $1,000, your first $10,000. Celebrate each one. Now, choose your first stream. Don't try to do everything at once. Pick one strategy that fits your skills, interests, and resources. If you're just starting out, index fund investing is a great place to begin. Open an account, set up automatic contributions, and let compounding work its magic. If you're more entrepreneurial, maybe you want to start a blog, a YouTube channel, or an e-commerce store. If you're interested in real estate but don't have a lot of capital, look into REITs or real estate crowdfunding platforms. The key is to start simple and build momentum. Once you've chosen your first stream, set up systems to make it automatic. Automate your savings and investments so you don't have to rely on willpower. Schedule regular check-ins, maybe once a month, to review your progress, adjust your plan, and celebrate your wins. Track your income and expenses and look for ways to increase the gap between what you earn and what you spend. That gap is the fuel for your passive income engine. As you build your first stream, start learning about others. Read books, listen to podcasts, watch videos, and connect with people who are a few steps ahead of you. Don't be afraid to ask questions or make mistakes. Every new skill you learn, every lesson you pick up adds to your toolkit.